On April 29, 2026, the Federal Reserve held rates steady. The headline hit every news ticker, every financial anchor read it, every retail trader nodded and moved on. Most of them missed the most important Fed signal in over 30 years. I am Marcus. This is Black Bear Trading. And today we are breaking down the one thing inside that April meeting that professional traders actually cared about, and what it means for your next trade. Quick note before we get into it. Everything in this video is for educational purposes only. I am not a financial advisor, this is not financial advice, and nothing here should be taken as a recommendation to buy or sell any security. Always do your own research and consult a licensed professional before making any trading decisions. When the Fed holds rates, the number that matters is not the rate itself. It is the vote count. On April 29th, the FOMC voted to hold at 3.50 to 3.75%. Completely expected. CME FedWatch had it priced at roughly 85% probability heading in. No surprise there. But the vote was 8-4. 8-4. That is the most fractured Federal Reserve decision since October 1992, over 30 years. 3 of those 4 dissenters, Cleveland Fed President Beth Hammack, Minneapolis Fed President Neil Kashkari, and Dallas Fed President Lori Logan, did not dissent because they wanted to cut rates. They dissented because they wanted to remove the easing bias from the statement entirely. There is a phrase the Fed uses in its statements when the next move is expected to be a rate cut. It says, additional adjustments to the target range. That is Fed language for, we are still leaning toward cuts. These 3 presidents wanted that language gone. They looked at the current data and said, we should not even be signaling cuts anymore. The 4th dissenter, Governor Myron, went the opposite direction. He pushed for an immediate 25 basis point cut. What you had was not a unified Fed pausing carefully. You had a committee actively at war with itself over whether rate cuts should even be on the table at all. Retail media covered the hold. Smart money read the split. Here is the thing. April was not the first warning. It was the third. The first signal came on February 18th, when the Fed released the January meeting minutes. Buried in that document was a line that most traders scrolled past. The minutes revealed that a majority of FOMC participants now view the risk of inflation running persistently above 2% as meaningful. That one word, meaningful. That is not the language of a Fed that is about to cut rates aggressively. When the minutes dropped, institutional bond traders repriced immediately. Most retail accounts, nothing changed. The second signal was the March dot plot. This is where every member of the committee submits their forecast for where rates should be at the end of each year. In March, 7 of 19 members projected 0 cuts for all of 2026. 0 cuts. And the Fed revised its PCE inflation forecast from 2.4% up to 2.7%. That was the largest single meeting upward revision since June 2022. Markets were still pricing in 1 to 2 cuts as recently as January. By the time the March dot plot dropped, that repricing was violent. 2-year yields spiked. Traders who had built their thesis around a spring cut felt that move immediately. And then came April, the 8-4 vote. Warning number 3. 3 separate signals, 3 months, each one more explicit than the last. The pattern was visible to anyone reading the actual Fed documents, not just the headlines. Here is what I think is the most important forward-looking signal in this story, and almost nobody is talking about it yet. Jerome Powell's tenure as Fed chair ends this year. His replacement is Kevin Warsh. Warsh has been publicly critical of the Fed's balance sheet for years. He has stated that the Fed's current holdings of over $6 trillion in Treasury and mortgage-backed securities have been unhelpful to the economy, and that aggressive reduction is necessary. To put that in context, the Fed's balance sheet peaked at $8.9 trillion. Quantitative tightening, the process of shrinking that balance sheet, ended quietly in late 2025 at $6.5 trillion. Most retail traders did not notice when it ended. Even fewer are thinking about what happens when a new Fed chair actively wants to restart it at a faster pace. Here is why this matters for your trades. When the Fed holds $6 trillion in securities, that is liquidity sitting in the financial system. If Warsh begins draining that liquidity more aggressively, selling treasuries, not just stopping reinvestment, you will see it in bond yields first, then in credit spreads, then in growth stocks, which are the most sensitive to changes in the discount rate and available liquidity. This is not a this-week trade. This is a structural backdrop every trader needs to understand heading into the second half of 2026. Let me give you 3 things you can do today. First, bookmark the CME FedWatch tool. The link is in the description. This is where you can see, in real time, what probability the market is pricing into each upcoming Fed meeting. When that probability shifts dramatically between meetings, not at the meeting itself, that is often where the edge lives. Second, read the actual FOMC statements yourself, not the headline, not the analyst summary. The actual document. The Fed releases a statement comparison with every meeting that shows you, word for word, what language was added or removed from the previous statement. One changed word in a Fed statement can move the bond market by billions. The link is in the description. Third, watch the 2-year Treasury yield. More than the 10-year. The 2-year is where institutional traders price their near-term rate expectations in real time. When the 2-year moves significantly without a corresponding move in the 10-year, that spread is telling you something about market confidence in the Fed's path. After the April vote, the 2-year jumped nearly 10 basis points in a single session. Those are not random moves. They are professionals repositioning around information that retail traders scroll past. The Fed does not hide its signals. The dot plot is public. The minutes are public. The vote counts are public. The statement comparisons are public. All of it is available to anyone with an internet connection and 15 minutes. The reason most traders miss these signals is not because the information is hard to find. It is because it requires slowing down, reading carefully, and thinking in probabilities, not headlines. Everyone reads. Fed holds. Moving on. The traders who outperform read. 8-4 vote. 3 dissenters want the easing bias gone. New chair incoming with a $6 trillion balance sheet problem. 2-year yield already repricing. What does my current positioning look like against that backdrop? That is the difference. All the links I mentioned, CME FedWatch, the FOMC calendar, Fed economic data, are in the description below. Organized by topic so you can start using them today. If this gave you a clearer picture of how to read the Fed the way professional traders actually do, subscribe. We post trade setups, market analysis, and breakdowns like this every Monday and Thursday right here on Black Bear Trading. I am Marcus. I will see you Thursday.